Hi guys, welcome to my channel. In today's video, we will learn about ways to measure mutual fund performance. So whenever you guys go for investing in mutual funds, there are various criterias or techniques you can go and evaluate your mutual fund. We are going to discuss in this video like beta, standard deviation, then Sharpe ratio, Treynor ratio, Jensen's alpha and information ratio, right? Along with this, we are going to see that all these techniques give you one value. Alright, it computes the one value of the various mutual funds available. Supposedly, we have portfolio A, B, C, D, right? For every portfolio, we are going to get one value, and then comparing these value, we can evaluate the performance of the mutual fund based on risk and returns, right? So all these value give you the one concrete value that will be comparable for the various number of mutual funds available in the market, right? So stay tuned till end. First technique over here we have is of beta. Now what does beta do? It measures how volatile the mutual fund portfolio is in comparison to the market, or we can say the benchmark, right? So we usually say that for market beta is always 1. Fine. Okay. Now if I say that beta calculated for mutual fund is more than 1. Okay. Say for portfolio A, my beta is more than 1. What does this mean? This means that our portfolio A has performed better than the benchmark, right? And if the beta is less than 1, what does this mean? It has performed lesser than that of the, say, market or the benchmarks, right? And it also says that our beta is highly volatile. So whenever beta is more volatile, that means there will be more risk and more returns. Now the formula to compute the beta is mutual fund return minus risk-free rate of return. Now risk-free rate of return is on your, say, fixed deposits, right? What else? Treasury bills or the government bonds, where your risk is minimum and your return is 99% assured, right? Okay, then it is being divided by benchmark return and risk-free return. Now if I say that the mutual fund, if I say for any of the mutual fund, the rate of return was 67%, right? And risk-free return was 5%, divided by our benchmark return, that was, say, 54%. And risk-free rate of return is again 5%. So if I compute my beta comes out to be 1.26. Now what does this value tell us? This value tells us that our beta, that means the portfolio has performed 26% better than that of the benchmark, right? Because I've already told you the beta of any of the benchmark is 1. So when my beta comes out to be more than 1, this means that the portfolio A has performed better than 26% in comparison to the benchmark, right? Now the last line is that beta does not give us absolute risk, rather it tells us the relative risk. Now what do you mean by this? I've told you, now over here when we computed the beta, we compared it with the benchmark, right? But it did not give us absolute or one value. Okay, so it is not giving us one value, but it is making a comparison. If we want to understand, we can say that there are two cars, that is Ferrari and BMW, right? If I say that Ferrari is faster than BMW, okay, then it is relative. It is making a comparison, right? But I cannot tell how fast Ferrari is. Absolutely, I cannot tell how fast the Ferrari is. This is the drawback of beta, that it gives you the relative risk and not the absolute risk, right? Okay, next technique is our standard deviation. Standard deviation tells us how the portfolio return deviates from the average, right? So we are going to see that we are going to compute the, if we have mean or say average of portfolio, how much the returns are deviating from the average. We are going to understand this with the help of example. Before that, you need to understand that mutual fund standard deviation reveals its volatility. Okay, so higher the standard deviation, if your standard deviation is high, that means volatility is high and risk is high. Higher the risk, higher the returns. Right? I hope you've understood. Along with this, you need to note that standard deviation measures the total risk. Now, total risk comprises of both systematic and unsystematic risk. Now, what is systematic risk? That is the risk that cannot be eliminated or mitigated through diversification, right? Whereas unsystematic risk, that can be mitigated by diversification of your portfolio. I hope you've understood till here, right? Let's understand the standard deviation with the help of an example. I've taken two portfolios, that is portfolio A and portfolio B, right? We've computed the returns over a period of time, say 2018, 19 and 20. Now for the portfolio returns, you can see that portfolio A has given in the 2018 15%, then in 2019 it was minus 7%, in the year 2020 it was 20%. However, for portfolio B, it has given 12% in 2018, 10% in 2019 and 14% in 2020. Now, just by seeing this, what can you say? Which portfolio is more consistent? Obviously, the answer is portfolio B. Right? It has given more consistent returns with minimum risk. With minimum risk, it has given me more returns. Right? So, keeping in mind the risk ability of any individual before investing in mutual funds, you can go for any of the mutual funds that are available with keeping in mind or comparing the standard deviations. I hope you've understood. Good. Next ratio is our Sharpe ratio. What does Sharpe ratio tells us? That means whatever returns a mutual fund is giving over and above our risk-free rate of return. Understood? Now, we need to understand one more thing, is that Sharpe ratio takes into account the standard deviation. Already discussed before that standard deviation takes into account both the total risk, right? That is systematic and unsystematic risk. Okay? Right? So, formula for computing the Sharpe ratio is mutual fund return minus risk-free rate of return divided by the standard deviation. Okay, so we'll understand this with the help of an example. We've taken two portfolios, that is portfolio A and portfolio B. Okay, so the rate of return over here for portfolio A is 10% and for portfolio B is 12%. Whereas the risk-free rate of return is same, that is 6%, and the standard deviation is given to us. And if you want to compute the Sharpe ratio, how can we compute the portfolio return? That is 10% minus 6%, that is risk-free rate of return, divided by the standard deviation. The value comes out to be 1. And for portfolio B, the value comes out to be 0.85. Now, if I see the Sharpe ratio, which one do you think is better? Obviously, portfolio A. Right? Why portfolio A? Because I can say that for every 1 unit of risk being taken, the returns that will be generated is 1 unit. Right? However, for portfolio B, for 1 unit of risk, how much return am I getting? 0.85. So, simply by seeing this, we can say that portfolio is A is better than portfolio B. Right? If you guys have any doubts, you can simply comment in the comment section. Okay. Next ratio that I'm taking into account is your tenure ratio. This ratio is similar to that of the Sharpe ratio, with one difference, that is it takes into account the beta. That means only systematic risk, right? Why? The basic assumption of tenure ratio is that unsystematic risk can be mitigated through diversification. So whenever you diversify your portfolio, this unsystematic risk can be managed, or it can be mitigated, and there's only one risk, that is systematic risk, right? Everything else is same like Sharpe ratio. This ratio is also known as reward to volatility ratio, right? Again, it tells you excess return over risk free rate of return to the market risk of an investment portfolio can earn. We'll understand this with the help of an example. Over here we've taken three portfolios, that is portfolio A, B and C, right? And then we have portfolio returns, risk free returns, beta, and then we've computed the tenure ratio. How do we compute the tenure ratio? Portfolio return minus risk-free return divided by portfolio beta, right? Putting in all the values, tenure ratio has been computed. Okay, so now when I see the tenure ratio is highest for portfolio B, what does this suggest? This suggests for every 1 unit of risk being taken, okay, for every 1 unit of systematic risk being taken, how much is the return? For portfolio A, it is 0.67, and for portfolio B, it is 0.89, and for portfolio C, it is 0.72. Right? You've understood? Higher the tenure value, better it is. Why? Because for every 1 unit, more and more return that can earn you, or it can fetch you more returns. I hope you've understood. Perfect. Now, let's move to Jensen's alpha. Now, what does Jensen alpha tells us? It evaluates the return of the fund over its index, right? We can simply say that it calculates the performance of the portfolio by subtracting funds beta from difference between funds and the risk-free return, and then multiplying the difference by the index return and the risk-free return. We are going to understand this with the help of an example, but in simple words, I can say it evaluates return of the funds over and above the index. One thing, right? Now, if I say my alpha is positive, what does this mean? This means my portfolio has outperformed, right? Whereas if I have negative alpha, that means the portfolio has underperformed. Understood? Okay, we'll do the example. Over here we have two portfolios, that is portfolio A and portfolio B, with the portfolio returns of 16 and 18% respectively. Risk-free return is the same, that is 2%. Market is on 10%, and beta we have, and then we have Jensen's alpha. Okay, I've already computed the value. Here is the formula, that is funds return over here we've taken, and then risk-free return minus funds beta into index return minus risk-free return. So if we put all the values, we get one value for portfolio A, that is 2.8%, and for portfolio B it is 0.8%. Now guys, see over here, what can you see? If I simply take into account the portfolio returns, okay, simply take into account the portfolio returns and nothing else. So which one do you think is more lucrative? Obviously, portfolio B is more lucrative when I take into consideration only the portfolio return. But when I compare it with the market and also take into account the beta, what is beta? Our systematic risk, right? When I take into account everything, that is risk-free returns, market index, and our systematic returns, systematic risk, so one value that I get, then I see portfolio A is performing better than portfolio B, right? Okay, so the last technique or the last ratio for today is our information ratio. Okay, so every portfolio is being managed by portfolio managers, right? So we say that how much has it beaten or how much the portfolio manager was able to say overtake the benchmark returns. Okay, and also taking into account the tracking error. What do you understand by the tracking error? How close was it to the benchmark returns, right? How close was the fund manager to the benchmark returns? So the tracking error indicates how consistent the fund is being able to generate excess return over the benchmark. Understood? Now, if I have low tracking error, what does this mean? There was minimum deviations, right? And the portfolio has outperformed the benchmark on consistent basis. We're taking into account the consistency. Next, if we have the portfolio that has high volatility, the tracking error will be more, right? Now, if I take into account the example, we have two portfolios, that is portfolio A and portfolio B, right? We have portfolio return of say 13% and 10% respectively, benchmark returns we have, and the tracking errors we have. So if I compute this with the help of the formula, that is portfolio return minus benchmark returns divided by tracking error, I get the information ratio. Okay, for portfolio A it was 1.25 and for portfolio B it was 1.4. Higher the information ratio, higher will be the returns, right? So which portfolio do you think is better? Portfolio B. I hope this video has helped you, and this video is going to help you further to determine which mutual fund you should go for your investment. If yes, then please subscribe to my channel. Thank you and have a nice day.